From the newsroom of Impact Alpha, this is your Impact Briefing for Friday, July 15th. I'm Monique Aiken. I'm pleased to welcome Margot Kane, Chief Investment Officer for Point Partners, to talk about family offices, catalytic capital, and emerging fund managers. Hi, Margot.
Hi, Monique. Thanks for having me.
But first, here's what you need to know from the week in impact investing. The 2022 proxy season is nearly over, and the results were sobering. Shareholder advocates had high expectations going into this year's annual general meetings after last year's dramatic wins at ExxonMobil and elsewhere. With few exceptions, the efforts fell short. So what gives? In a guest post on Impact Alpha, Majority Action's Eli Karsagad-Staub lays the blame at the feet of BlackRock, Vanguard, and State Street, which together control 25% of shares across the S&P 500. His take? BlackRock and Vanguard, in particular, appear to have voted against ambitious action on climate risks. Calls for racial equity audits fared better, winning majority votes at McDonald's, Apple, Johnson & Johnson, and Home Depot. JP Morgan Chase, Pfizer, and Verizon came to agreements with racial equity proponents. But a proposal for a racial equity audit at Chevron fell just short of a majority. BlackRock, holding 6.5% of the oil company's shares, voted no. The crisis in Sri Lanka gave birth to an irresistible narrative that a crash transition to organic farming sent the country into an economic and political tailspin. The problem is that it's not true. Rather, the mess that was made of the country's agricultural policy says more about the country's poor governance than it does about organic farming. The tip-off? A poorly timed tax cut hamstrung the government's ability to respond to the economic crisis. Impact Alpha's Jessica Pothering has the story. Big private equity firms continue to make big impact plays. KKR said in a filing that it has raised nearly $1.5 billion for its second global impact fund. The private equity giant's first close is already bigger than its $1.2 billion first impact fund. The difference? KKR's Ken Melman said in a recent talk, "This time, there are proof points." He said KKR's first fund, which has made 15 investments, has recorded a gross internal rate of return of more than 50%. And British International Investment, that's the former CDC group, committed up to $250 million to the electric vehicle spinoff of Indian automaker Mahindra & Mahindra. India has a target of 100% EVs by 2030. So Margot, welcome to the briefing. This week you had a great piece in Impact Alpha about how to boost the impact of catalytic capital in supporting emerging fund managers. First, tell us a little bit about how Point came around to this strategy.
So we were founded a couple of years ago in Philadelphia, so relatively new entity ourselves. We are a social impact organization. We invest in transformational leaders, networks, and solutions that power community change and advance justice. So we deploy multiple tools for that to advance that mission. One of those tools is investments. So we are a mission-driven organization and have multiple strategies that we focus on. One of those strategies is really rooted in economic justice, and that for Spring Point, considering kind of where we operate in the asset owner and philanthropic world, is really focused on how can we build opportunities for wealth generation for people that have historically been excluded from those opportunities or systematically stripped of opportunity to build and retain wealth. And that's really a strategy aiming to figure out effective ways to leverage investment to close the racial wealth gap. So one of the ways in this current, capitalist economy in which we operate, that you can build meaningful wealth, the kind of wealth that can be transferred intergenerationally, is through business ownership, and specifically through high growth business ownership. Things like venture-backed businesses or other forms of businesses that are profitable, cash flowing, and not, survival mode businesses. So those kinds of businesses build ownership build wealth for their owners and also build wealth for their employees.
So could you tell us about some of the fund managers you've seeded or anchored as a result of this?
Sure. So one of them, I'll start with Philly since we're here. One of them is Plainsight Capital, which was founded by Sylvester Mobley and Alex King. And they came together to launch an early stage firm really focused on emerging founders in tech, which corresponds directly with both their own individual experience as entrepreneurs, but also with Sylvester's experience founding a really successful not-for-profit here in Philly called Coded by Kids, which trains youth to be both founders and also really high-level operators in high growth tech businesses. So they have a really specific strategy and footprint and thesis. They're putting together a team, but because they're not coming with their own vast personal wealth to start a management company in private equity and really survive that fundraising gauntlet, which typically lasts more than a year, as we know now. They needed some supports to get this up and running, and so we did two things in Plainsight's case. We provided some support for the startup operating expenses of the fund, knowing that bringing folks on full time is a upfront expense, and a lot of investors are wary about supporting solo folks that are starting a fund. They need a team, they need partners, and if you've already got one, that just doubles your expense burden before you're earning any management fees. So that's one of the things that we did. And the other thing we did with Ben Franklin Technology Partners here in Philly was provide a warehouse line for Plainsight to start making investments and build that quote unquote new team track record before they go to market later this year to raise the fund in earnest. Because that's another really key barrier we see first time fund managers, and particularly fund managers of color, face.
So we often hear about flexible, patient, and risk-tolerant elements of catalytic capital. And you made the point in the piece just that how such investment capital is deployed is just as important as the deployment of the capital itself. So tell us a little bit about how you try to change the process or go against the grain. And you mentioned power dynamics. That's not often heard from the LP side of the equation. So, there's some sensitivities in your piece that I think are really important to both visibilize and name as you do this work.
I mean, I wish I could say I had it figured out, Monique, but I'm still learning this as well. So I can share some examples of how it's come up, how missteps I've made, and how we're working on figuring it out because there is this inherent power dynamic in investing, full stop, right? And I've been on both sides of the table my whole career, so I know some of it, and it really takes intention and time when you're on the investor side to think about where the partner on the other side is coming from and how they're experiencing your process, particularly when they're new to fundraising in this milieu, right? In this fund manager context, since none of these first-time fund managers we're supporting, for example, are unused to fundraising. They're extremely successful fundraisers in lots of other contexts. And one of the things that was so challenging in kind of launching the strategy was we would spend many months in the diligence getting to know the fund managers, building trust, trying to kind of articulate our motivation in supporting them and understanding what their motivations were in terms of entering this industry. And then we would get to legal documentation, right? And that's just a horrible trust destroying experience, especially if you just leave it to the lawyers. I love lawyers, got lawyers in my family, but right, trust building is not their strong suit. And we just kept having these impasses, which is not, unusual in deal work, right? Especially in first time closes or complex structures. But because the trust was so critical and the relationship quality is so critical to success in these cases, that's one place where we really rethought what our process was on the close and also how we managed legal review. So, for example, we don't do lawyer to lawyer stuff. My team and I run interference. So we receive our counsel's comments. We use our discretion to figure out which ones we're going to go with, and kind of repackage those. And we try to keep the conversation at business lead to business lead as much as possible. We went through kind of standard LPAs and picked out what terms are market for a good reason and what terms are market for bad reasons, like just because it's precedent, right? And there's some very standard language we have in a bunch of different LPAs that's really kind of gross, but you're going to have counsel that's like, well, that's market, which is my least favorite defense of any term, because it means nothing, because it means different things to everybody. So really trying to figure out, like, what do we care about and why, and then what are we gonna negotiate and why, and then instead of being like, this is how you need to change things, we would say, tell us why you structured it this way, which is differently than how we've seen it before, and be open to living with it, and not having to redline everything to death, to get us over the finish line, accepting some of that ambiguity and discomfort when there was really good reason for it. And I'll give you a very specific example. In some cases, the removal of the GP language in most of these fund agreements includes things like, if you're convicted of a felony, which when you are intersecting that with folks of color, specifically, Black leaders who, have a history of being unjustly accused under the law, that's a really problematic thing to have your investors be like, oh, well, we can remove you in case, this happens. And this is your business. This is your lifeblood. You've poured your savings into this. So those are some of the things that we've thought about changing in terms of how we do it. And on diligence process, there, in each stage we've been adjusting. Like, we'll piggyback on other folks' diligence calls and reference calls, really in order to try to reduce the time load of fundraising on these managers and increase efficiency for them.
And in that vein of intentional thinking, on each step of the process, there's fund one, and after that, fund two. And often that's created for some of these emerging fund managers and the obstacles being them the first time around. So what do you make of that, and what can we do about it?
Such a good question. And this is something that we're wrestling with now, and in conversation with our first time managers, as well as folks who have made it over that hurdle, about, because you're really making the transformation in some ways from, Matt Conwell, who raised his fund on Twitter effectively from individuals amazingly, to getting, more institutional folks in the door, to grow that fund size. And it's essential. I know some people talk about, well, why grow your assets under management? What's the point? And the point is, in order to execute on your strategy and build a team, you need that. That's the business model of funds. And all these folks are operating when they're undercapitalized on, pennies, basically, and cannot, hire the team that they want to execute the work. So we're very much in favor of planning for the long term. And part of our diligence in Fund 1 is understanding where the fund manager is in terms of thinking about Fund 2, 3, and 4, and trying to think about the infrastructure pieces that need to go into place. And we're sort of starting to see that now on the horizon, and doing things like, let's talk early about your key terms and how, which ones you're going to fight for and which ones you're going to try to make as plain as possible. Let's talk now about compliance infrastructure. How would you deal with an operational due diligence questionnaire? And there's a bunch of infrastructure that doesn't make sense to ask of a first-time fund manager because they're not going to have the time or capacity to execute on it. But as long as they know it's coming, you can help build their capacity over time. and provide those supports. I think what I talked about in the blog was bringing in that expertise. They're not going to have a chief compliance officer on day one. They may never, because you can outsource that now, right? But just flagging that by the time you're at fund three, you have to be able to answer this question. I think that goes a long way in helping them plan ahead. They're entrepreneurs in their own right. It's no different than funding early stage businesses and figuring out what kind of expertise and supports you can bring to the table.
And another point I deeply appreciated in your piece was about letting go of some of the instinct to mitigate every risk by overstructuring or other things that might actually hamstring the success of the folks essentially working at cross purposes of your own interest as well as the interest of the person you're purported to be looking to support. So as a chief investment officer, how do you think about some of those other risks that are named that people try to structure away or do other things that relate to control that are not truly in your scope, to your point of some of the other ways you've rethought?
So I think one of the hardest things in investing is knowing the risk you're taking, because you're always taking one. You're always taking some risk, right? Always. Even if you're putting cash under your mattress, you're taking risk of a house fire or a burglar. So, pretending you can mitigate it all away is silly. And we also know that people perceive certain risks to be higher when they're less familiar with those risks. There's a perception gap versus an actuality gap on risk profile. So the first thing that we did was get very clear internally about what risks we're willing to take. And we are willing to take risks on first-time teams, first-time models, in exchange for building new centers of entrepreneurship and investment that are really centered in founders of color, in equity, in more diverse representation. That's a risk we're willing to take. Not everyone can say that, but that is something that we also kind of watch very closely. And as I think I said in my piece, that the main mitigant is the quality of your relationship. Which is one of the reasons why having a kind of a trust-destroying diligence process is a bad idea. If you want to take this kind of risk, you also have to think about how you interact with folks. And I think, unfortunately, especially in the self-identified catalytic capital space, we're not used to adjusting, right, to the realities of others. There's less accountability for our business model relative to theirs. And most of their investors aren't going to be catalytic investors. And some of that, awareness of, understand the risks you're willing to take, understand the risks that other people will take, and try to get them to take the risks they're cool with and take the risks that you can uniquely take. And being a catalytic capital provider means there's a lot of risk you can take. That's why you're there. But you have to be internally clear on it and eyes wide open.
And so when we think about structure and who's capable of delivering on catalytic capital goals, you mentioned that you can do some things that other investors can't. Why is that? And how can you all lean into that and maybe bring others along with you?
Yeah, that's a great question. And I think that's some of the hardest work that honestly, I think the broader industry hasn't fully figured out. The reason that Spring Point can take that kind of risk is because our founders really were intentional about our structure, and they structured for maximum flexibility. That's how we were able to get really clear on what risks we were willing to take versus which ones we weren't, and construct an investment strategy around it. We were not bound by tools that are required because of the form of our institution. We're an LLC, highly flexible. we're not crafting our investment strategy for tax optimization of any sort or to meet compliance requirements, which you see, there's a lot of capital out there that's doing great work. Folks that are deploying CRA capital, certainly PRIs, but they are bound by the nature of the tool, which is tied to the nature of the institution. And then there's on top of that folks that are, managing other people's money. They're not asset owners themselves. They're fiduciaries. They're being held to a particular, standard. And unless the asset owners say this is the kind of risk I want to take, they can't unilaterally make those kinds of decisions. So structuring to be catalytic, and I really liked how Rebecca Butler put it at Grow Foundation, is setting a return target, right, that enables them to be catalytic was required. Putting up that, policy statement and setting it up in that way. Those kinds of intentionalities are required. It doesn't happen by accident. But I do think lots of different kinds of investors can take a catalytic lens. I don't think it means everybody needs to have patient and low cost and first in money. I think if you're managing, more traditional sources of capital, you can still make moves in ways that can influence markets and generate outsized impact, as long as you know what risk you're taking and you're comfortable taking it.
Well, I am delighted to have had this conversation with you. Thank you so much for joining us today, and for your humility. You wrote a great piece, so we do hope that we see you again soon.
Thank you so much for having me, Monique, and I really enjoyed the conversation.
And that's going to do it for this week's Impact Briefing. What you just heard was an excerpt of a longer conversation I had with Margot, and we'll release the full interview next week. Thanks to Margot and our producer, Isaac Silk. Subscribe to get full access to Impact Alpha and the Daily Brief. Right now, we're offering podcast listeners $100 off their first subscription. Go to impactalpha/subscribe. Go to impactalpha.com/subscribe and use the code Briefing100. Thank you for listening. I'm Monique Aiken, Managing Director for TIP, the Investment Integration Project. Be sure to check back for next week's briefing, and until then, take care.